All right. Well, this first problem in part two is very similar to one that we had in yesterday's video. Matter of fact, I think it's exactly the same, except for our order sells for 450. I believe it was four yesterday. And so we have to, I just walked through this again. What is the contribution margin per each sale? Well, the selling price is 450. And then we have the food cost of $2. And then we've got these two variable expenses, advertising and royalty, because it's a franchise, right? So 2.5% of 450 is, let's see, advertising, and that's 0.1125. And then we've got 8%. That's 36 cents. And that is for the royalty. And so our 450 minus 2 minus 0.1125 and minus 0.36 gives us $2.275. If you wanted to round there, 0.03, that would be fine on this one, but I'm going to carry it through like this. What is the break even in units? So to that we have to get the total fixed costs. So we have the lease of $750. We've got the equipment lease of $400. We've got the license of $600 per year. We need to get that in months. Let's see. So $600 per year would be $50 per month. Salaries to $2,500 per month. Utilities $400 per month, and insurance $1,500 per year is going to be $125 per month. And that'll be $42.25 per month. So we take the 42, let's see, so that's going to be $42.25 divided by 2.0275. And that's going to equal 2,084, round up from the 0.8, 2,084. And then says the potential franchise before tax profit. So that'll be the 42.25 plus 2,000 divided by 2.0275. So we need 3,071 units to achieve the $2,000 profit. All right. So that's the first one. The second one, we've got the Durable Tractor Company manufactures small tractors on assembly line basis. The units are started in Department Y, January 1st in the year. Work in process inventory 400 units, 100% complete with materials, 20% complete as to conversion. During the month, 800 units were started, 600 units completed and transferred out. Work in process was 100% complete for materials, 40% for conversion. All right, and we jump down here, we see the production report using the weighted average method. So the first thing is we need a physical flow schedule. January 1st, so we had 400 units, and then we started 800 units. So our units to account for is 1,200. Finished and transferred out. 600 were finished and transferred out. That means 600 were in ending inventory, giving us 1,200 units. Now we're using the weighted average method, so if they're completed and transferred out, the equivalent units are the same as the physical flow method. And then we are told the 100% complete as to materials and 40% complete, so 240 as to conversion. 1,200 equivalent units for materials, 840 equivalent units for conversion. Then we need the cost, the cost per equivalent unit. So we had 100,000 beginning, 200,000 in materials is a total of 300,000 divided by 1,200 is 250. Okay. That's our cost per equivalent units for materials. Our cost per equivalent units for conversion is 25,000 in the beginning inventory and 143,000 added this period gives us 168,000 divided by the 840. And that ought to be something like 20. $200 off the decimal point. Okay, so $200 per unit, equivalent unit for that. Then we need to know the cost of goods transferred out. So we'd have 600 times 250 plus 200 is 450. Is 270,000 is the cost of goods transferred out. And then our ending inventory is going to be 600 times 250 plus 240 times 200. It's 150,000 plus 48,000 equals 198,000, our ending inventory. All right, so that's a weighted average method process costing problem. Next one, this one is going to be, same thing, process costing, but this time we're going to use FIFO. So with FIFO, we're going to use our beginning work in process. Is 4,000 units. Started is 28,000 units. That gives us 32,000 units to account for. Now, we do need the completed direct materials, 80% complete. 80% of 4,000 is 3,200. 40% complete for conversion would be 1,600 there. Now, on the completed and transferred out, we know the ending inventory was 2,000 units, so that means we had 30,000, sorry, completed and transferred out. That gives me 30, yeah. Okay, so now to calculate the equivalent units for materials, 30,000 minus 3,200 is 26,800. 30,000 minus 16,000 is 28,400. The ending inventory, direct materials, is 60% complete, or 1,200. And 50% complete for conversion is 1,000. Add those up, and we get 28,000, and we get 29,400. So that's answer for A. And then B, it says cost. We need the cost for equivalent units of conversion. So we get 112,000 divided by the 28,000. Is $4 per unit, equivalent units. And then for conversion, it's the 88,200 divided by the 29,400. Whoops. I think I subtracted instead of divided. And we get $3 per unit for that. Okay, so that is B. The cost completed and transferred out is for materials is going to be the 44,000 plus the 26,800 times the 4. So we get 107,200 for that, plus the 44,000 is 151,200. And then for conversion, we're going to have the 35,800 plus the 28,400 times 3. So 85,200 for that term. Add the 35,800. Whoops. And we get 121,000. So the total completed and transferred out, add those two together, is 272,200. That's C. And then the ending cost of work in process inventory is going to be materials is going to be 1,200 times 4 is 4,800, and conversion is going to be 1,000 times 3 is 3,000. And add those two together, 7,800. The reason I was balking there for just a second is if you look on the cost per unit, the beginning inventory costs are way out of line with what we added this period. And so I'm like, is that right? And yeah, I did it right there. But but the costs are way out of line in the difference. I mean, we did 7 times as much work, just rough here now. 7 times as much work. You had 28 versus 4, and yet it's less than 3 times the cost. So yeah, so those happen with textbook problems. Okay, so the following material standards have been established for a particular product. Standard quantity per unit of output is 6.3 feet. Standard price is $13.60 per foot. Following data, actual materials purchased is 1,000 feet. Actual cost of materials, $13,300. Actual materials used in production is 400 feet. And the actual output is 60 units. And we want to know what's the material price variance for the month. Calculate at the time of purchase. So we had total cost, the actual cost was $13,300. This standard based on inputs, right, or the flexible budget based on inputs is going to be the 1,000 purchase times the standard of $13.60 would be 13,600. And so this is our first one is 300 favorable. Okay. And then what is the materials quantity variance for the month? So we're going to use the actual materials. This is that double middle column that we talked about. So we've got 400 times 1360 here. Is 5,440. And then here we're going to use the standard. The actual output was 60 units times 6.3 feet times 1360. So we've got 378 times 1360 is 5,140.80. And so the quantity variance is 299.2 unfavorable. Remember, the one on the right is bigger, it's favorable. So that one. Okay, our next one. Spyro Inc. has 2 service departments and 2 producing departments. Information has been provided as follows. Overhead costs, maintenance. Maintenance costs are allocated on machine hours, and personnel costs are allocated on number of employees. So A, we want to use the direct method. So cutting is going to be so we're going to do this. The 90 and the 30 is 120. I'm just going to knock off the zeros. Divided by 120 times 160,000. That's going to be 3/4. That's going to be 120,000. And then the assembly is going to be 30 over 120 times 160,000, or 1/4 equals 40,000. And then for the personnel, we've got 140 and 160. So that's 300. 140 divided by 300 times personnel cost of 300,000. 300,000 is 140,000. Yeah, I should have realized that. Right, the 300s cancel there. And then the assembly is going to be 160 divided by 300 times 300. And that's going to be 160,000. So that will be 200,000 total allocated to assembly, and 260,000 allocated to cutting. And then B, they ask us to do it the step down and want the largest cost first. So that's going to be personnel. So maintenance is going to get personnel is based on hours. So now we've got 310 times 300,000 equals 9,677. I'm just going to round it there. Cutting is going to be 140 divided by 310 times 300,000. Is 135. 484. I'm going to round up there. And then maintenance, assembly. I'll move assembly down here. Will be 160 divided by 310 times 300,000. is 154, 839. Okay, so we're done with the maintenance, but I do have to add that 160. Okay, so now this is going to be the same. Cutting is going to get 90 over 120, but this time instead of 160,000, it's 169,667. 3/4 is 127,250.25. So I'll just round it at that. Add to that 135,484, and we get 262,734. And if you compare that up here, it's $2,700 off. All right. Assembly is going to be 30 over 120 times 169,667. Would be 42,417. And we get 197,256 on that. All right, so that's B. Okay. The next one, Frogtown Company versus a single product. Standard unit costs are materials 2 pounds at $5 a pound, 2 times 5. Labor is 4 hours at $8 a pound, or $8 an hour, excuse me. And then overhead is 4 hours, the variable overhead. And it looks like we just have a single overhead. We don't have variable and fixed here. Okay, so that's just going to be 4 times 12. On that, the units produced are 1,100. So we can put in 1,100 here. That materials purchased and used, 2,100 pounds at 108. 21,500 times 5 is 107,500. So our price variance is 500 unfavorable. 1,100 times 2 times 5 is 11,000. And so we've got 3,500 favorable for the usage variance. Right. This is the price. This is the usage. Calculate the labor variances. The actual labor was $356,000. We used 45,000 hours. Our standard rate is $8 an hour. So that would be 360,000. So our labor rate variance is 4,000 unfavorable. And so 1,100 times 4 times 8. $11,000. Huh. I did that up here. Let me go back up to the first one. 11,000. Be 110,000. I actually did it right, even though I got the wrong number up there. That's scary. All right, 11,000 times 4 times 8 is 352,000. And so, whoops, I said that was unfavorable. That's favorable. Long day. And this is 8,000 unfavorable here. The overhead variance, actual overhead, 578,000. The actual hours were 45,000 again, times a rate of 12 is 540,000. So our spending variance is 38,000. This one is unfavorable. And 11,000 times 4 times 12 is 528,000. So this is actually an efficiency variance, and it's 12,000 unfavorable. And those efficiency variances usually are the same direction. Since we don't have fixed overhead, we don't have a production volume variance to worry about. Okay. We have an income statement in the contribution margin format. So we've got our sales minus our variable cost minus our fixed cost. The projected income statement was based on 12,000 units. They have the capacity for 15,000 units during the year. And it's determined the break even in units. So the easiest way to do that would be to take our contribution margin of 144,000 and divide it by our basis of 12,000 units. So it should be 12, I think. Yes, it is. So that gives us a contribution margin per unit of 12. And so now we need the fixed costs of 120,000 divided by 12. And so we need 10,000 units to break even. On that, B, the sales manager believes the company could increase sales by 1,000 units if advertising were increase by 15,000, determine the effects on the income. All right, so B, the easiest way to do that is to take the 1,000 units times the contribution margin per unit of 12 is 12,000. Subtract off the 15,000. And so we would be 3,000 worse off to engage, to spend 15,000 to get a contribution margin of 12,000. And then C, what is the maximum amount the company could pay for advertising if the advertising would increase sales by 1,000 units? So we would break even on the advertising at 1,000 would be 12,000 here. So we would break even with that. So C would be 12,000. That's the most we would break even on that. Okay, next. We have controller is analyzing direct material and direct labor variances for 2005. And we want to calculate the direct material and direct labor variances. Okay, so we had direct materials of 180,000 was the cost for 600,000 pounds. The standard is times 0.25 per pound, so that's going to be 150,000. This is calculating the variance at the time of purchase. So we have a 30,000 unfavorable. Now we could calculate it at the time of usage, in which case we would take the 180,000 and divide it by 600,000. And we would get 30 cents per unit. So 550,000 times 30 would be 165,000. Here we would use the 550,000 times 0.25. Would be 137,500, and so you get 27,500 unfavorable. This would be calculated at the time of usage, and this would be at the time of purchase. All right, then we have to do the usage variance. So this is going to be the middle column there. 550 times 0.25 is 137,500. The standard would be 0.5 times 0.25. And the number of units that we used, or the number of units that we produced, was 1 million units. And that'll be 125,000. So we've got 12,500 unfavorable for the materials usage variance. Okay, you don't have this double thing on the labor because we can't store labor. Our labor costs were $3,780,000. Our actual use was 270 hours. Our standard rate is 15. So we would have 4,050,000. And again, we have the 1 million. The standard direct labor is 0.25 hours at $15 per hour. Would be 3,750,000. Okay, so we've got 300,000 unfavorable here. We have 270,000 favorable there. Okay. The next one, following information is based on, okay, we've got a FIFO process costing. So our physical flow schedule is 100,000 units in beginning inventory. Transferred in, that's the same as started, is 540. So we've got 640,000 units to account for. See, with transferred in, that's like putting all the materials at the beginning. So our transferred out was 400,000. And so that means our ending was 240,000, ending inventory 640. And so we just need to do the conversion cost here on this one. So our equivalent units, beginning inventory were 60% complete. So that would be 60,000. Ending inventory was 30% complete. I think that's 72,000. Yeah, 72,000. 400 minus 60 is 340,000. So we have 412 equivalent units for conversion. Well, it says which are on August 31st. I'm assuming that's the end of the month. Yeah. Okay. Well, I have to actually have to do B before I can do A on this one. So my cost per equivalent unit is going to be 242 and then divided by 412. And I get 58.74 cents on that. So now, so this is B. So for A, I need the work in process on the end of the month would simply be the 72,000 times the 0.5874 would be 42,291. Round off those 0.26 cents. $0.26. And then C, what were the total transfer costs out? And so it's going to be our beginning cost of 30,400 plus the 340,000 times the 0.5874. So I get 199,716. $230,116. Okay. So yeah, that one we didn't have the materials because the materials come from a prior processing unit. Now we've got another standard costing problem here. The Koski company has established the following standards: units produced, actual production figures. Compute the standard variances. Okay, so we've got direct materials, direct labor, and variable overhead. And we'll do the direct materials at the time of purchase here. So we bought 3,000 pounds at $12,300. The standard would be 3,000 pounds times 4 would be 1,200. 12,000. So our materials price variance was 300 unfavorable. Now, the amount we actually used was 1,600 times 4 would be 6,400, and the standard for 500 units times 3 pounds times $4 a pound is $6,000. So our materials usage variance is 400 unfavorable. Okay. So that's the materials. Then we have the labor. The direct labor cost was $7,790. We had 950 hours times a standard of $16. Oh, it's kind of $8 per hour. Okay, 900. Okay, so we've got a variance of 190 unfavorable. We produce 500 units times 2 hours times $8 is 8,000. And so we've got 400 favorable. This is the efficiency variance. So they worked a little faster than we anticipated. And then finally, we have the variable overhead cost incurred, 4,655. The same. Variable overhead is based on the 2 hours direct labor up there. So 950 times $5 an hour is 4,750. So we have 95 favorable here. And then the standard is 500 times 2 times 5 would be 5,000. So we have 250 favorable there. Okay. All right. The next one is a flexible budget performance report. Castillo uses customers served as its measure of activity. During December, the company budgeted for 29,000 customers, but actually served for 2,700 customers. The customer bases its budgets on the following information. Revenue should be $440 per customer served. So we've got the actual, we've got the flex budget, and then we've got the static budget. All right, so the static budget would be revenue of 440 times 29,000 would be 127,600. And we actually served 27,000. So our flexible revenue would be 118,800. The actual revenue was 117,600. Okay, so that's our revenue. Wages and salaries should be 33,000 a month plus $1.80 per customer served. Supplies should be $1.60. Okay, so our wages and salary actual was 83,500. It should have been 27,000 plus 33,300 is 81,900, and the static budget was for 1.8 times 29,000 plus 33,300 would be 85,500 for wages and salaries. The next one up is for supplies. Supplies should be 60 cents per customer served. It came in at 17,400. 27,000 is 16,200. 29,000 is 17,400. Insurance should be 8,900 a month. And it actually came in at 9,100. And then finally, miscellaneous should be 4,600 plus 10 cents per customer served, so 29,000. And so the static budget would have been for 7,500. The flexible budget would be for 7,300, and the actual miscellaneous was 9,800. All right, so that's our numbers. Now we just have to do the variances. This is our flexible budget variance. So we've got 1,200 unfavorable, right? We want the actual to be greater, and it was less. And then the static budget would be 8,800, also unfavorable. Wages and salaries, 1,600, unfavorable. The flexible budget, again, this is one I don't really agree with, but is 3,600 favorable. I don't really agree that's favorable because it's only favorable because we because we served less customers, but that is the traditional way of noting it. Okay, so supplies would be 1,200 unfavorable. Again, 1,200 favorable. So we were, there. 200 unfavorable for insurance. This is NA, right? And then miscellaneous would be 1,500 unfavorable and 200 favorable. Okay. All right, this is number 2 on the page. Says Erie Company uses machine hours to apply overhead and has the following operating data. Okay, so another standard costing. And so we want the overhead variances this time. Okay, the variable overhead came in at 260,000. The standard machine hours, actual machine hours was 98,000. And so we had $2.50 total machine hours, 100,000. Total variable overhead, 250,000. So that would be by $2.50. Right up here. And so 98,000 would be 245,000. So our spending variance is 15,000. This is the variable overhead spending variance, 15,000 unfavorable. Okay, we had the actual units manufactured was 2,250. The standard machine hours was 100,000 machine hours. Whoops. Divided by 2,500 is 40 machine hours times a rate that we calculated of $2.50. That doesn't look right to me. 2,250 times 40 times 2.5. And yes, it was 225,000. All right, so we are 20,000 unfavorable for the efficiency. This is the spending. Okay, then we need to do the fixed overhead. So the fixed overhead incurred was 64,000. The budgeted fixed overhead was 50,000. So our spending variance was 14,000 unfavorable. Then we do the applied. So 50,000 divided by 100,000 machine hours is 50 cents per machine hour. So we'll have the 2250 times 40 times 0.5. So 45,000. And so our production volume variance is going to be 5,000 unfavorable. And our last one for this session, another standard costing. So this is based on 60,000 direct labor hours. Our direct materials, okay, so our material cost, 779,000. We had 380,000 pounds at $2 per pound would be 760,000. So our price variance is going to be 19,000 unfavorable. We made 128,000 units times 3 pounds times $2 per pound. $768,000. So our usage variance is 8,000 favorable. All right. So the next one that we have is the labor. And so this is the price, and this is the usage. Next one we have is the labor. The labor was 507,150. We used 63,000 hours at a rate of $8 per hour. Is 504,000. So our labor rate variance is 3,150. Unfavorable. We should have used 128,000 times 0.5 times 8 would be 512,000. So we have an efficiency variance of 8,000 favorable. Then we do the variable overhead. The variable overhead was 220,000. The variable overhead, the same as the direct overhead, or the direct labor, 63,000. The rate, however, is times 3. Is 189,000. And then over here we have the 128,000 times the 0.5, but now we're at the 3 per hour. So 128 is 192,000. Okay, so this is our spending. Variable overhead spending variance, that'll be 31,000 unfavorable. And this is our efficiency variance. This is also efficiency, but it's the labor efficiency. And that's going to be 3,000 favorable. And generally, like we've mentioned before, generally those are the same direction. Finally, we get the fixed overhead. The fixed overhead was 365,000. The budgeted overhead is 360. Okay, so the spending, this is also spending, but it's fixed overhead spending, is 5,000 unfavorable. And then the production volume variance is based on the applied. And so the applied is 0.5 hours at $6 per hour. So we have 128 times 0.5 times 6, so that's going to be double, 384,000 there. So we have 24,000 favorable. Now, why is that? It's based on 120 units, and we made 120,000 units, and we made 128,000. All right, so a lot of standard costing in that one. I hope it helps.